Today, I want to share with you one of the most powerful investment strategies I've ever studied. It comes from Warren Buffett, one of the greatest investors of all time. And people always ask the same question about him. How did Buffett make money when everyone else was losing everything during market crashes? The answer might surprise you. He didn't make money during the crashes exactly. He made money because he owned the right things going into those crashes. And those assets, those specific types of investments, they protected him and allowed him to not just survive, but actually thrive when markets collapsed. Warren Buffett has lived through more than a dozen major market crashes over his investing career. The dot-com bubble in 2000, the 2008 financial crisis, the COVID crash in 2020, and many others before those. And here's what's fascinating. Every single time, he had the same four types of assets in his portfolio, the same four categories of investments protecting his wealth, growing his fortune, even when everything around him was falling apart. And that's what I want to break down for you today. These four asset types that Buffett has consistently held through every crash. Because if you're serious about investing for the long term, if you want to build real, lasting wealth, you need these four things. Not just one or two, all four of them. They work together synergistically. They protect each other. They create what Buffett calls a fortress around your wealth. And when the next crash comes, and believe me, it will come, you'll be prepared. So let me start with the first asset type, and it's the most important one according to Buffett's philosophy: cash. Now I know what you're thinking. Cash? Really? Cash doesn't grow, it just sits there losing value to inflation. And you're absolutely right about that. Cash is indeed a terrible long-term investment. But here's the key insight from Buffett's teachings. Cash isn't meant to be an investment, it's ammunition. Think about what happens during a market crash, when everyone's in panic mode and selling frantically, when the market's down 30, 40, even 50%. That's precisely when the greatest opportunities appear. That's when phenomenal businesses go on sale, when you can literally buy a dollar's worth of value for 50 cents. But here's the catch. You can only capitalize on those opportunities if you have cash available. If you're fully invested, if every single dollar you own is tied up in stocks and other assets, then when the crash happens, you're paralyzed. You just sit there watching these incredible opportunities pass by, unable to act on them. Warren Buffett has always maintained significant cash reserves, always. At Berkshire Hathaway, they typically hold somewhere between $20 billion and $150 billion in cash and cash equivalents. A lot of people criticize this approach. They say, you're losing purchasing power to inflation. You should invest that cash. But Buffett's perspective is different. He's not losing money. He's being strategic. He's waiting patiently for opportunities, for market dislocations, for those moments when he can deploy that cash at extraordinary prices. Let me give you a perfect example from Buffett's playbook: the 2008 financial crisis. Everything was collapsing. Major banks were failing left and right. The market state was in complete freefall, and Buffett had cash, enormous amounts of cash. So he was able to make deals that others couldn't. He invested $5 billion in Goldman Sachs, $3 billion in General Electric, and later made strategic investments in Bank of America. Not because he was braver than everyone else, not because he had some crystal ball, but simply because he had cash when they desperately needed it. And those investments, they generated billions in returns, literally billions of dollars in profit. But here's the critical point. He could only make those investments because he'd maintained cash reserves, because he hadn't been fully invested when everything was rising. He'd been patient. He'd been waiting for his moment. You see, cash provides you with optionality. When you have cash available, you can take action when others are frozen. You can be greedy when others are fearful, as Buffett famously says. But without cash, when you're fully invested, you're stuck on the sidelines. You can only watch helplessly. And watching great opportunities slip away, that's one of the most frustrating experiences in investing. Now, how much cash should you maintain? Well, according to Buffett's principles, that depends on several factors. your age, your risk tolerance, your living expenses, but as a general guideline, you should always have at least 6 months of living expenses in cash. That's your emergency fund, your safety cushion. And beyond that baseline, you should maintain cash that you can deploy for investments. Buffett calls this dry powder. How much exactly? Again, it varies, but somewhere between 10 and 30% of your investable portfolio. Here's the key insight. When the market's expensive, when valuations are high and people are euphoric, hold more cash. When the market's cheap, when there's blood in the streets, as they say, hold less cash, because that's when you should be deploying it. The essential principle is always maintain some cash reserves. Never be 100% invested, because market crashes are inevitable. They always come eventually, and when they arrive, cash becomes king.
Now let me move on to the second asset type in Buffett's framework, high-quality businesses. And I want to emphasize, not just any businesses, not stocks you're hoping will go up, but genuinely high-quality, enduring businesses with sustainable competitive advantages. During a market crash, virtually all stocks decline. Everything goes down, really. But not all businesses are impacted equally. Some businesses, the truly great ones, actually emerge stronger from crashes because their weaker competitors fail, allowing them to capture market share and acquire assets cheaply. And when the economy eventually recovers, they're in an even more dominant position than before. Let me share one of Buffett's most famous examples, Coca-Cola. He purchased shares in 1988 and has held them through approximately 5 major market crashes. And every single time, Coca-Cola comes through essentially unscathed. Why? Because people continue drinking soft drinks, even during recessions, even during depressions. Consumption might decrease slightly, but it continues, and Coca-Cola has built this incredible brand equity, this massive global distribution network, these deep relationships with virtually every retailer and restaurant on the planet. You simply cannot replicate that infrastructure. It's what Buffett calls a moat, a competitive advantage that actually widens over time. So when the market crashes and Coca-Cola's stock price drops 30 or 40%, Buffett doesn't panic. Why? Because he understands the underlying business, and he knows the business fundamentals remain solid. Eventually, the stock price always catches up to the business reality. It's inevitable. That's what high-quality businesses do. They survive crashes. They continue generating profits, continue serving customers reliably. And if you own them, if you simply hold steady and resist panic selling, you'll be fine. Actually, better than fine. Because when the market recovers, you'll return to your previous level and then continue climbing higher. But if you own low-quality businesses, companies that are heavily leveraged, highly cyclical, or overly dependent on economic conditions, they might not survive the crash at all. They could go bankrupt, and then your entire investment becomes worthless. That's the fundamental difference. That's why quality is so critically important. So what makes a business high quality, according to Buffett's criteria? Well, there are several key characteristics to look for. First, the business must have a strong competitive advantage, a moat, as Buffett calls it, something that genuinely protects it from competition. This could be brand power, network effects, economies of scale, regulatory advantages, something substantial. Without a moat, competitors can easily enter the market and erode profitability over time. Second, it must generate significant cash flow, real, tangible cash coming into the business, not just accounting earnings or revenue growth, actual cash generation, because cash is what ultimately matters. Cash enables the business to survive difficult periods, pay dividends to shareholders, and invest in future growth. Third, it requires excellent management, leaders you can trust, people who are both intelligent and ethical, who think like true business owners rather than hired executives, because even a great business can be destroyed by poor management decisions. And fourth, the business should sell products or services that people genuinely need, not merely want, need, or at minimum strongly desire, in both good economic times and bad. Because if it's selling discretionary items that people can easily eliminate from their budgets, it will struggle significantly during recessions. So those are the characteristics of high-quality businesses in Buffett's framework. And if you build a portfolio containing 5 or 10 or 15 of these exceptional businesses, you'll navigate crashes successfully. Not because they won't decline in price, they will, but because they'll survive, recover, and continue growing over the long term. That's the second critical asset type. Now let me discuss the third asset type, bonds. And I realize bonds aren't exciting, they're not glamorous, they don't generate much conversation, but they're important, really important, according to Buffett's overall strategy. You see, bonds, especially high-quality bonds like U.S. Treasury securities, they provide something that stocks cannot: stability and negative correlation. They often rise when stocks fall. During a market crash, when panic is spreading everywhere, investors flee towards safety. And safety in financial markets means government bonds. So when stock prices are plummeting, bond prices typically rise, or at minimum, they don't fall nearly as much. This helps cushion your overall portfolio. It reduces your total portfolio volatility. Now, Buffett himself isn't a major bond investor personally. At Berkshire Hathaway, they don't hold large bond positions because they have alternative methods of providing stability to their portfolio. But for most individual investors, bonds absolutely make sense, especially as you age, especially as you approach retirement. Because when you're young, you can tolerate significant volatility. You have decades to recover from market crashes. But when you're older, when you're actually living off your investment portfolio, you cannot afford to lose 30 or 40% of your wealth. You need stability and predictability, and bonds provide exactly that. Now, it's crucial to understand that not all bonds are created equal. Some bonds are extremely safe, like U.S. Treasury bonds. The federal government will never default on those obligations, at least in dollar terms. But other bonds, corporate bonds, high-yield junk bonds, they're risky, genuinely risky. During severe market crashes, those bonds can lose just as much value as stocks because the underlying companies might face bankruptcy. So if you're going to hold bonds in your portfolio, stick with the highest quality options: Treasury securities, perhaps some highly rated investment-grade corporate bonds, but nothing too speculative or risky. Because the entire purpose of holding bonds, the fundamental reason they're in your portfolio, is safety and stability. If they're not delivering that, then what's the point of owning them? How much of your portfolio should be allocated to bonds? Again, it depends on your individual circumstances, but there's a traditional rule of thumb that says your age in bonds. So if you're 30 years old, hold 30% in bonds and 70% in stocks. If you're 60, hold 60% in bonds and 40% in stocks. Now, I don't think you need to follow that formula rigidly, but it's a reasonable starting framework. The key principle is this: as you age, you should gradually shift more of your portfolio into bonds and stability-focused investments because you have progressively less time to recover from major market crashes.
And that brings me to the fourth and final asset type in Buffett's crash-proof framework: real assets. Now, what exactly do I mean by real assets? I'm talking about investments that have intrinsic physical value, tangible value, things that cannot go to zero because they exist in the physical world. Real estate, commodities, agricultural land, infrastructure assets, things that will always retain some fundamental value because they have actual physical substance. Let me tell you about Buffett's favorite category of real assets: farmland. He owns agricultural land, not enormous amounts, but meaningful positions. And he's explained why he loves this asset class. Because farmland will be there no matter what happens in financial markets. The stock market can crash catastrophically. The economy can plunge into recession. Major banks can fail. But the land? It's still there. Still producing crops, still generating income from agricultural production. And farmland is actually an excellent investment during economic crashes because people need to eat, always, regardless of what's happening in the broader economy. So farms continue producing, continue generating cash flow, continue paying rent if you've leased them to operators. It's stable, reliable income. Now, real estate can be an excellent real asset category as well, but you must be careful and selective. Not all real estate investments are equivalent. If you own residential real estate in an overheated market and that market crashes, you could suffer substantial losses. We witnessed this dramatically in 2008. Housing prices declined by 30, 40, even 50% in some regions. But if you own real estate in fundamentally strong locations, places where people genuinely want to live and work, and if you're not over-leveraged with excessive debt, then real estate can provide both stability and consistent rental income streams. The other category of real assets that Buffett emphasizes, and this might surprise some people, is productive business assets. Real, tangible, operating businesses. Not just stock certificates, but actual functioning enterprises. At Berkshire Hathaway, they own numerous examples of these: railroad companies, utility companies, manufacturing operations. And these businesses are fundamentally real. They possess physical assets, equipment, buildings, infrastructure, machinery, assets that retain value even if stock markets crash. And they continue operating, continue serving customers, continue generating cash flow. That's what Buffett loves about them. They're grounded in physical reality. Now, most individual investors cannot purchase entire businesses outright, but you can acquire ownership stakes through publicly traded stocks. And if you select the right companies, businesses with substantial real assets and genuine cash-generating ability, you're getting exposure to real assets, not merely pieces of paper, but actual productive capacity and tangible infrastructure. That's what provides protection during market crashes. So those are the 4 asset types in Buffett's framework: cash, high-quality businesses, bonds, and real assets. Now here's the absolutely critical point. You need all 4 categories, not just 1 or 2, all 4 working together, because they complement and balance each other. Cash provides flexibility, the ability to take action when opportunities arise. High-quality businesses provide growth potential, the ability to build substantial wealth over extended time periods. Bonds provide stability and downside protection when stocks are falling. And real assets provide a foundation, a floor, something with intrinsic value that cannot evaporate to zero. Together, these 4 asset types create a genuinely balanced portfolio, one that can survive major crashes and thrive in the recovery periods afterward. Let me illustrate how this played out in Buffett's case during 2008, the financial crisis. Going into that crash, Berkshire Hathaway held all 4 of these asset types. They had cash, substantial amounts, approximately $40 billion. They had high-quality businesses, Coca-Cola, American Express, Wells Fargo, plus dozens of wholly owned operating companies. They held some bonds, not huge amounts, but meaningful positions. And they had real assets, railroads, utilities, manufacturing facilities. So when the crash happened, when the stock market fell 50%, yes, Berkshire's portfolio declined in value, but not nearly as much as the broader market, because they had that balance, that diversification across asset types. And more importantly, they had available cash, so they could take action. They could make strategic investments while others were panicking and selling. Goldman Sachs approached them, desperately needing capital, so Buffett invested $5 billion on extremely attractive terms. General Electric needed capital urgently, so he invested $3 billion there as well. And those investments generated enormous returns, billions upon billions of dollars in profits. But he could only make those investments because he maintained cash reserves, because he'd preserved that crucial balance across asset types. You see, that's how you survive market crashes, according to Buffett's philosophy, not through luck, not by trying to time the market perfectly, but by holding the right mix of assets, by being prepared in advance, by owning cash when opportunities emerge, by owning businesses that survive and thrive, by maintaining stability through bonds, by having a foundation in real, tangible assets. That's the fortress. That's your protection system.
Now let me discuss how you can build this framework for yourself. because most people aren't managing hundreds of billions of dollars like Buffett does. You might have $10,000 saved, or $100,000, or perhaps $1 million. The specific amount doesn't matter. The fundamental principles remain the same, regardless of portfolio size. Start with cash. Make absolutely certain you have an emergency fund. 6 months of living expenses at minimum. That's non-negotiable. That's your safety net for life's unexpected events. Beyond that baseline, maintain additional cash for investment opportunities, somewhere between 10 and 30% of your investable assets. This percentage depends on current market conditions. When everything appears expensive and overvalued, hold more cash, be patient, and wait. When assets are genuinely cheap and undervalued, hold less cash, because that's when you should be deploying it aggressively. Next, construct a portfolio of high-quality businesses following Buffett's criteria. Identify 5 or 10 or 15 companies that you genuinely understand. Companies with sustainable competitive moats, with powerful brands, with excellent management teams. Purchase them at reasonable valuations, and then simply hold them for the long term. Don't trade actively. Don't attempt to time short-term market movements. Just own genuinely good businesses and let time do the heavy work of compounding your wealth. Then add an appropriate allocation to bonds based on your age and circumstances. If you're relatively young, perhaps just 10 or 20% in bonds. If you're approaching retirement age, maybe 50 or 60% for stability. Use your age as a general guideline, but adjust based on your specific personal situation, risk tolerance, and income needs. And stick exclusively with high-quality bonds, primarily Treasury securities, perhaps some highly rated investment-grade corporate bonds. Nothing speculative or risky, because remember, the entire purpose of the bond allocation is stability and capital preservation. And finally, obtain some meaningful exposure to real assets. This is admittedly the most challenging category for many individual investors because you can't simply purchase a farm if you only have $10,000 to invest. But you can buy stocks of companies that own substantial real assets, utility companies, railroad operators, real estate investment trusts that own property portfolios. Or you can own real estate directly yourself. Perhaps a rental property or even your primary residence counts as a real asset. The key principle is this. Have something in your portfolio that's grounded in physical reality, something that produces actual income from real-world operations, something that will always retain fundamental value. Now let me explain what happens when you actually implement this strategy, when you build a portfolio containing these 4 asset types. Market crashes will still be painful, they always are. You'll definitely see your portfolio value decline, but it won't fall nearly as much as the overall market because you have that balance, that built-in protection across different asset categories. And more importantly, from a psychological perspective, you won't panic because you'll know you have cash reserves available. You'll know your businesses are high quality and will survive. You'll know your bonds are providing stability and cushioning the downside. You'll know you have a foundation, a floor of real assets beneath you. And that knowledge, that deep-seated confidence, is what enables you to think clearly and rationally. It allows you to make sound investment decisions instead of emotional, fear-driven mistakes. The biggest mistakes in investing, according to Buffett's observations, are almost always emotional mistakes rather than analytical mistakes. Panic selling during crashes, greedy buying during bubbles, mindlessly following the crowd, all emotional reactions, all driven by fear or greed rather than logic and careful analysis. And the way you avoid these emotional mistakes is by being prepared in advance, by maintaining the right asset allocation, by having a clear plan that you've committed to beforehand. When the next major crash arrives, and it absolutely will arrive eventually, you won't panic because you'll know you're properly prepared. You'll know you have everything you need to survive and even thrive. And that confidence is genuinely priceless. It cannot be overstated how valuable that psychological advantage is. Let me emphasize one more critical concept about opportunity. Market crashes aren't merely threats to be feared. They're also opportunities to be embraced.
The very best opportunities in all of investing occur during market crashes, when everyone is panicking, when exceptional companies are trading for 50 cents on the dollar, when fear dominates everything and rational analysis has completely left the building. That's when you can make truly extraordinary returns. That's when generational wealth gets created. But you can only capitalize on those opportunities if you're prepared beforehand, if you've maintained cash reserves, if you have the right psychological framework, if you're not panicking along with everyone else. Buffett wrote a famous op-ed for the New York Times in October 2008, right in the middle of the financial crisis. His message was simple: "Buy American, I am." People thought he was completely crazy. The financial world was collapsing, and he's recommending stocks? But he wasn't crazy at all. He was prepared. He had enormous cash reserves. He had confidence in his high-quality businesses. He recognized this was an extraordinary opportunity, and he was absolutely right. Over the following years, those investments generated billions in returns. But here's the key insight. He could make those investments because he'd been prepared, because he'd maintained his 4 asset types in proper balance, because he didn't panic. That's the power of proper preparation. That's why these 4 asset categories matter so tremendously. Let me start bringing this together and summarizing the key points. I've been talking for quite a while now, and I hope you've really absorbed what I'm trying to convey. These 4 asset types, cash, high-quality businesses, bonds, and real assets, they're not just nice to have, they're absolutely essential if you want to build genuine long-term wealth, if you want to survive inevitable market crashes. And those crashes are definitely coming, I can guarantee you that. I don't know exactly when, could be next year, could be 10 years from now, but they're coming. They always do throughout market history, and when they arrive, you need to be ready. You need to have these 4 asset types properly balanced and working synergistically. Because here's what Buffett has learned through 75 years of investing experience. Building wealth isn't about being brilliant or having genius-level IQ. It's not about making the next Amazon or Tesla before anyone else. It's about surviving over many decades, about staying in the investment game through multiple market cycles, about not making catastrophic mistakes. And the way you survive is by being prepared, by maintaining cash when opportunities arise, by owning genuinely high-quality businesses that genuinely endure, by having stability from bond allocations, by having a foundation in tangible real assets. That's the fortress Buffett talks about. That's the comprehensive protection system. And if you build it properly, if you maintain it consistently, you'll survive every market crash that occurs. And not merely survive, actually thrive. Because while everyone else is panicking, while everyone else is losing wealth, you'll be calm, you'll be prepared, you'll be ready to take decisive action. When Buffett reflects on his long career, when he thinks about all the wealth he's accumulated over the decades, he emphasizes that it didn't come from being the smartest investor. It didn't come from some secret proprietary strategy or brilliant, unique insight. It came from being consistently prepared, from maintaining these 4 asset types, from surviving every single market crash, and from having the courage to act decisively when others were paralyzed by fear. That's the entire game according to his philosophy. That's everything that matters. So here's the practical advice I can offer you, based on Buffett's teachings, stated as clearly as possible. Build your financial fortress starting today. Get these 4 asset types properly in place. Maintain cash reserves always, somewhere between 10 and 30% of your portfolio. Never be 100% invested in stocks. Own genuinely high-quality businesses, companies with sustainable moats, powerful brands, excellent management teams. Hold an appropriate bond allocation for stability and protection when stock markets fall, and obtain meaningful exposure to real assets, land, real estate, infrastructure investments, things that will always retain fundamental value. Do all of that, and you'll be properly prepared. And when the next major crash inevitably arrives, when everyone around you is panicking, you'll remain calm. You'll be ready, and you'll have the opportunity to build substantial wealth, just like Buffett has done through every single crash in his career. You know, people often ask what Buffett says he's most proud of in his career. And according to his own statements, it's not the money itself. It's not being one of the wealthiest people in the world. It's that he survived in the investment game for over 75 years, through every crash, every crisis, every panic. He stayed in the game continuously. He never blew up his portfolio. He never made catastrophic, career-ending mistakes. And that's fundamentally because he maintained these 4 asset types. They protected him. They gave him confidence. They enabled him to act when others couldn't. And they'll provide the same benefits for you if you build them, if you maintain them consistently, if you're patient enough and disciplined enough to stick with the strategy. Well, I think that covers everything I wanted to share with you today. 4 essential asset types based on Warren Buffett's proven approach: cash, high-quality businesses, bonds, and real assets. This framework has protected him and generated billions in returns during every market crash in his career, and it will protect you as well if you implement it properly. So build your fortress starting now. Be prepared, and when the crashes come, and they absolutely will come, you'll be ready. You'll survive, you'll thrive, and you'll look back years from now, decades from now, and be grateful that you took this approach. I genuinely believe that. This is one of the most valuable investment frameworks you can possibly learn.